Hello world, my name's Zara and I'm a full stack developer with a passion for investing. Today I'd like to do a stock analysis on SBUX. But before I do, I'd like to tell you about my special relationship that I have with this company. Back in 2009, I think, I was playing poker at Foxwoods with about $3,000 on the table. And I was joking how the price of SBUX went down to about $7 a share. And at that time, a cup of coffee cost about, $2, $3, $4 a share. So I was joking that, if the price goes any lower, they can just offer you a free coffee with every share that you buy. So I missed out big time on this one. So that's one of my regrets. But I can't really say that I missed out too much because I wasn't considering buying it in the first place. So it's not too much of a regret. So I would just like to start with saying that SBUX is a company that I'm considering buying for myself and for my daughter, and that's why I'm doing the stock analysis on it today. And the first thing that I always look at is revenue growth. So I went to the Motley Fool website because you can look at the last 12 quarters of revenue growth, earnings growth, and dividend growth. And it's just visually very appealing to see. So I noticed that SBUX is growing revenue at about 6%, which is a little bit slower than I thought it would be. And analysts are predicting around 10 to 12% growth for this company. And earnings are expected to be 55 cents a share, and that is up from 49 cents a share 1 year ago. So that's about 11% growth in earnings, give or take. So I guess if you take the average of revenue and earnings growth, I guess they're expected to grow about 8 or 9%. They do have a lot of stores opening up in China, so that's probably where the majority of their growth is coming from. In America, the only sources of new revenue they have, since they already have stores everywhere, their new revenue is coming from food sales and perhaps alcohol sales. I know they have a high-end coffee shop called Reserve. I don't know how that's rolling out, but I know that's either in the works or just started. They also own Teavana. So I've seen that not too busy when I've passed by the stores myself. So I don't know how much credit I'd give that. So the next I'd like to talk about is their dividends. They have been growing dividends very, very nicely. Currently, they are paying out 1.7%, and that's based on SBUX currently at $58 a share. So that will probably go up in about 6 months from now. It seems like every 4 quarters they raise their dividend. Previously, they raised it from 20 cents a quarter to 25 cents a quarter. So 25 cents times 4 is $1 per year. So that is decent, and they are raising it, and they have plenty of cash to raise it. Currently, they're paying out about 45% of their earnings. That's called a payout ratio. So they're expected to be earning 55 cents, and they're expected to be paying out 25 cents of that money in dividends. So for every 1 share you have, you get 25 cents every single quarter for the rest of your life. Unless they grow it, then you get more than that. So that's one of the great things about dividends and holding stocks forever. One of the things that is keeping me from buying this stock myself, this is the most concerning thing to me, is that the PE ratio, the price of the stock divided by the earnings of the company, is 29. So we are paying 29 times what this stock earns in a year, what this company earns in a year. And that's a little bit on the high side. This is more than the general market, the average of the general market, the S&P 500. And I'm not quite sure that SBUX has the growth to justify such a high PE ratio. Although they do have a cash flow ratio, price to cash flow ratio of 21, which is good, which means that they are actually earning more cash every quarter than they are showing on the books, because on their income statement they account for things like depreciation and amortization. So 21 times cash flow is not too concerning. And also considering how great this stock has done over the last 5 years. This stock has gone up about 100% over the last 5 years. They've grown revenue over the last 5 years, about 100% over the last 5 years, and they've grown earnings like ridiculous. So considering that management has been good and they have a great track record over the last 5 years, maybe a price to earnings ratio of 29 is not too much, and a price to cash flow ratio of 29 is not too much. So in conclusion, I think that this stock might be a buy. If you want to look at the whiteboard really quick for a second, if the stock is $58 right now, and this is the 58 line, over the last year, the stock kind of traded like this, up and down, up to 58. And now we're right about here. So now we're right about 58 again. So whereas this used to be a resistance line for the stock, and this used to be a support line down here. I don't remember exactly what this number was down here, but it was kind of going up and down, and it was hitting a resistance of $58 a share. And then at one point it broke out above $58 a share, and now we are back down to $58 a share. I think this stock will probably go over $60 again, and I think in the long term, this will be a good stock to buy and definitely has the potential to go to $120 a share over the next 5 to 10 years. But I'm not exactly sure if I like buying it at the 58 level, or if I think I can buy other stocks with my money that have better growth prospects. I know Starbucks is growing in China, maybe 1 to 2 stores a day, but I think there are other companies that I can choose from that are growing a little bit quicker, because Starbucks is already such a big company. Right now, the stock is, let's see, $85 billion company. And if you look at their balance sheet, they have, let's see, I wrote it down here. They have $2 billion in cash. Their total assets are $14 billion, but they have $8.6 billion of liabilities, giving them only $5.6 billion in equity. So for an $85 billion company to only have $5.6 billion of equity, which is what the company would be worth if they had to sell everything today, if they went out of business, $5.6 billion is not a huge number, and $2 billion in cash is not a huge number for a company of this size. So I'm not sure. I think this stock is probably a long-term buy, but there might be better stocks to buy out there. Anyway, thank you for listening, guys. Whoever made it to the end of the video, thank you so much for listening, subscribing, liking. I love you all, and I will try to do a daily stock analysis about once a day. Thanks so much. Have a good night.